In November 2023, AbbVie agreed to buy ImmunoGen for $31.26 a share. 1 month earlier, before the first acquisition rumors, the stock traded at around $12.50. Inside the merger filing, the board's financial advisors laid out every standard valuation method in the book: comparable public companies, precedent transactions, discounted cash flow. Not one of them reached the price AbbVie paid. The highest range topped out around $20.40. So, either one of the largest pharmaceutical companies in the world overpaid by 50%, or the question, what is this company worth, doesn't mean what you think it means. First, you need to know what these documents are and what they are not. When a public company in the United States is acquired, shareholders receive a proxy statement. Buried inside, under headings like selected public companies, selected precedent transactions, and discounted cash flow analysis, is something rare: the valuation work that professional advisors actually put in front of a board before a multi-billion-dollar vote. But here's the distinction that matters. These are not the buyer's internal models. The buyer's synergy estimates, its strategic option value, its maximum willingness to pay, those almost never become public. What you're reading is the analysis prepared for the target's board by the target's advisors to judge whether the offer is financially fair. That doesn't weaken what follows. It's what makes it honest, because it gives you a clean sequence to compare deal after deal: market price, standalone value, trading comparables, precedent transactions, and the negotiated price. One note on method: once. In this episode, inputs are narrated as approximations. Results are never rounded. The difference matters, and you'll see why. Start with the cleanest case on file. June 2017, Amazon agrees to pay $42 a share for Whole Foods. The day before, the stock closed at $35.45. The board's advisors ran the standard sequence. Comparable grocery retailers at 7 to 9.5 times forward EBITDA, roughly $28 to $39 a share. Precedent transactions at 8 to 10 times trailing EBITDA, $31.84 to $39.93. The discounted cash flow at a 7 to 9% discount rate, $37.11 to $51.22, using a terminal multiple, wider still using perpetuity growth. Amazon paid 42. Look at what just happened. 3 methods, 3 different ranges, none of them identical, but they overlap. They form a zone of plausibility, and the negotiated price landed inside it. That's the first lesson, and it's the anchor phrase of this episode. Valuation produces ranges, not answers. A DCF is not a machine that discovers the correct number. It converts assumptions into an interval, and there's a trace of what Amazon believed it was buying. In the preliminary allocation filed with Amazon's third quarter 2017 results, every identifiable asset and liability was measured at fair value: the stores and equipment, the contracts, the brand itself. What remained, by definition, is called goodwill, the excess of the price over everything that could be separately identified. For Whole Foods, that residual came to $8,985 million, 68% of the $13,176 million paid. Amazon attributed it primarily to expected improvements, future growth, and benefits that could not be separately recognized. In plain English, Amazon could identify roughly a third of what it paid for. The rest was what it believed Whole Foods could become inside Amazon. Remember that. It comes back at the end. A multiple looks objective. It's a number, multiplied by another number. But before any multiplication happens, someone has to decide which companies belong in the comparison. And that decision is a judgment call worth billions. June 2016, Microsoft agrees to pay $196 a share for LinkedIn, a premium of 49.5% over the last close. The board's advisors analyzed the same company through two different lenses. Lens 1, LinkedIn as a consumer internet company, 12 to 18 times projected modified EBITDA, implied value roughly $122 to $177. Lens 2, LinkedIn as software as a service, 4 to 7 times projected revenue, implied value roughly $142 to $238. Same company, same day, same advisors, different peer set, and the ceiling moves by more than $60 a share. The multiple looks objective. The decision about which companies deserve to be compared is not. And this isn't an anecdote about one deal. A 2024 study in the Review of Accounting Studies examined over 13,000 advisor multiples across 2,300 US public deals. Even after standardizing them, the single most common multiple accounted for less than 8% of the sample. It takes 22 different multiples to cover 80%. There is real choice being made, deal by deal, not boilerplate. And the research on which peers get chosen points in two directions at once. One study finds advisors selecting peers with higher multiples, raising the bar to negotiate a better price. Another finds peers with lower multiples when litigation risk rises, making the agreed price look more attractive. Both biases exist, both are documented, and neither requires a villain, only an objective that was never precisely defined. Hold that thought. October 2018, IBM offers $190 a share for Red Hat. The unaffected price, $116.68. The board's advisors ran the sequence. Comparable public companies, roughly $105 to $140.50. The base case DCF, roughly $108 to $140. If you stop there, $190 would look indefensible. But precedent transactions, the prices buyers actually paid to take control of comparable software companies, implied $146.50 to $207.50, inside the range. Here's what that gap is telling you. A trading multiple prices minority shares, the company as a company, run as it's currently run. A transaction multiple prices something else. The right to change capital allocation, combine operations, redirect strategy, and keep the asset away from everyone else. Those are two different assets. They trade in two different markets. That same 2024 study puts numbers on how often each lens gets used. Trading comparables make up 66% of advisor multiples. Transactions, 34%. And here's the arithmetic consequence. The median 30-day premium in that sample was 30%, which means the choice between the two bases isn't a technicality. Anchoring on trading comparables sets a bar that is systematically predictably lower. American corporate law, by the way, does not say which one advisors should use. Nobody does. To be fair to the trading lens, precedent transactions carry their own noise. Different cycles, different synergies, and sometimes past overpayments baked into the benchmark. Neither lens is the truth. They're answering different questions, which is exactly why IBM's 190 is neither vindicated nor condemned by these ranges. It's located by them, outside the standalone world, inside the market for control. One more assumption quietly dominates almost every DCF you'll ever see: the terminal value. In the classroom version, you project cash flows for 10 years, then assume they grow at 2.5% forever. For a mature business with durable cash flows, that can be reasonable. December 2021, Pfizer agrees to buy Arena Pharmaceuticals for $100 a share. Unaffected price, $49.94. The board's advisors built a risk-adjusted DCF. Discount rate 8 to 9.75%. Standard so far. Then look at the terminal growth assumption. Negative 70%. A second separate analysis used -60 to -80. That is not a typo, and it is not pessimism. It's a description. A pharmaceutical asset doesn't grow gently forever. When the patent expires, when competition arrives, the cash flows don't plateau, they collapse. The terminal assumption reflects the runoff economics of a finite-lived asset. And with that assumption in place, the risk-adjusted DCF implied roughly $86 to $107 a share. Pfizer paid $100. Inside the range, because of the unusual assumption, not despite it. This is the deepest version of the episode's lesson. The terminal formula is not a ritual you perform at the end of a spreadsheet. It is an economic claim about the asset, the single largest claim in the model. Grows at 2.5% forever is not a default, it's a statement. So is declines at 70. The question is never whether the assumption is standard, it's whether the assumption describes the thing you're valuing. Put the four cases side by side. Whole Foods. Methods produce overlapping ranges, and the price lands inside the zone. LinkedIn. Choosing the peer set moves the zone itself. Red Hat. Standalone value and control value are different assets, priced in different markets. Arena. The terminal assumption is where the model's real claim about the world lives. So, when someone asks what is the company worth, you now know the question is underspecified. There is a market value, a standalone value, a control value, a value to buyer A, a different value to buyer B, and at the end, a negotiated price. No model collapses those into one number. That was never the model's job, which raises the uncomfortable question this episode is actually about. If the valuation doesn't determine the price, and you've now seen 4 deals where it demonstrably didn't, why does every American public company merger produce one? The answer starts in a Delaware courtroom in 1985. In Smith v. Van Gorkom, the directors of a company called TransUnion approved a takeover without adequately informing themselves of its terms, and were held personally liable for it. Here's the detail that makes it interesting. The court did not make expert valuations mandatory. It said explicitly that outside valuation was not required by law. What it did was make the cost of approving a sale without an informed process painfully clear, and that was enough. Within a few years, obtaining an expert valuation before accepting an offer became standard operating procedure for American target boards, close to universal, without ever being written into statute. An institution can become practically mandatory without being legally mandatory. So the cynical reading writes itself. The document arrives late, after the price is already negotiated. Directors almost never vote a deal down because of it. The advisors are paid when the deal closes, a rubber stamp with a 7-figure fee. That reading gets the timing right. It gets the mechanism wrong. Here is the counter strategy of this episode. The valuation document is solicited during the acceptance phase, when the offer is already on the table. In that narrow sense, it does not drive the price. The critics are right about the sequence, but everyone at that table has known, since the very first phone call, that this document would eventually exist, that every term they negotiate will one day be laid out next to conventional benchmarks, in a public filing read by shareholders, by analysts, and, if eligible shareholders, dissent and seek appraisal, potentially scrutinized by a Delaware court, where many of the same assumptions about cash flows, discount rates, and deal process come under examination. That anticipation is the discipline, not the document, the shadow of the document, cast backward over the entire negotiation. The researcher behind that 13,000 multiple study compares it to an audit. The effect of an audit is not limited to the cases where the auditor says no. It operates on every number, precisely because everyone knows the audit is coming. So the document that appears to exist to justify the price after the fact is, in practice, what disciplines the price before it is proposed. Its stated purpose is ambiguous. Courts never define exactly what advisors are supposed to value, and that ambiguity is older than any bad faith. There is no villain here. There is an institution that works sideways. Can you measure a shadow? Almost. There's a setting where disclosure switches on and off. Acquisitions of private companies. Under SEC significance rules, above a 20% threshold, the public buyer must file the target's audited financial statements after closing. Below it, those specific audited statements generally aren't required. A study in the Journal of Accounting Research examined 1,615 of these deals. Where disclosure kicked in, buyers went on to show operating performance about 3% higher over the following 3 years. And remember Whole Foods, a probability of goodwill write-downs nearly 6 percentage points lower. Evidence consistent with the disciplinary effect of disclosure, measured in private deals, not the 5 you've just seen, and with the author's own caveat that the study does not weigh disclosure's costs. Now you can go back to the beginning and read it correctly. The filing shows AbbVie's proposal did not start at $31.26. Its first proposal in early November 2023 equated to roughly $21.80 a share, sitting almost exactly at the top of the DCF range. Then the process turned competitive. The advisors even ran a fourth kind of analysis. The premiums buyers had actually paid in comparable biotech takeovers, applied to ImmunoGen's unaffected price. Even that lens, the takeover market itself, implied values topping out around $25 to $27. On November 29, a competing bidder delivered its final binding offer, $23.50. The same day, AbbVie delivered its own, $31.26. So the ranges were never a ceiling, and they weren't a minimum price rule either. They were reference points, the benchmarks the board would eventually have to explain the negotiated price against. Beyond them, competition and buyer-specific economics took over. The pipeline, commercialization, what the asset is worth inside AbbVie specifically. The filing shows the escalation. It cannot decompose the final number between those forces. Whether AbbVie's assumptions were right, the filing cannot tell you either. Some of them are sitting on AbbVie's balance sheet right now, under a single word: goodwill. So the valuation doesn't set the price, and it doesn't cap it either. It sets the frame, the benchmarks against which that price eventually has to be explained, in public, in writing, which means the useful question was never simply, what is the company worth? It's, what assumptions have to be true for this price to make sense, and true for whom? The buyer answers with money. The board answers with a document. And the document doesn't tell negotiators what price to choose. It makes sure they choose knowing exactly what benchmarks that price will be compared against. Every strategy creates a counter strategy.